Hi, I'm Jamin Yi, and on behalf of my colleagues at Roehl Yi, welcome to our Money Manager interview series. A foundational part of our investment management strategy is due diligence. Our process begins with the 4 Ps: performance, process, philosophy, and people. In all the years I've had the opportunity to meet directly with investment firms, I've learned the most important part of money manager research is people. In the end, after all the analysis is conducted, we want to answer this question: do we trust our clients' money with these managers? I hope you enjoy getting to know some of the managers we utilize and gain perspective and insights on their respective strategies. Today, we're joined by Tony Crescenzi, Executive Vice President at PIMCO. Tony is a member of PIMCO's investment committee, a portfolio manager at PIMCO. He's written 6 books on the bond market and a regular on CNBC and Bloomberg. Tony's going to discuss the economic environment in 2021. This interview was recorded on February 4th, 2021. The views and opinions expressed here are as of the date recorded and should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of Roehl Yi Investment Advisors and are subject to change without notice. Welcome, Tony. Thank you for joining us.
Thanks, Jamin. It's a great honor to be here.
PIMCO's most recent research piece is titled Bounded Optimism. Can you share your economic forecast for 2021? What are you optimistic about? What is bounded? And what are you concerned about?
That's a great question, Jamin. And let me start by saying perhaps the numbers won't be as important as the themes. The IMF, the International Monetary Fund, for example, recently said that economic growth worldwide will be the best in 40 years, matching the peak level seen one other time in 2007. And so PIMCO has a similar forecast, expecting robust economic growth. For example, in the United States, we think economic growth will be 7% or so this year as a growth rate, and that economic activity will reach 2019 levels sometime mid-year. Globally, it's a little bit different, a little slower. In Europe, for example, it'll reach 2019 levels of GDP, perhaps in the middle of next year. But that doesn't mean that we recovered. It simply means getting back to a previous level. And given that a growth trajectory is about 2% of growth per year, that means we'll still have a shortfall, what we would call an output gap, where the amount of economic activity might be back to the peak, but it's lower than where we potentially could be growing, because there are more people in society and productivity has increased. So growth potential is 2% per year. So what I'm trying to say is that economic growth will be extraordinarily robust. It relates to the vaccine distribution, so therefore a better virus path, massive fiscal stimulus, massive monetary stimulus, pent-up demand, and so on and so forth. You asked as well, Jamin, what the risks are and what is bounded. We see some of this playing out in the United States lately, in Washington, where President Biden is not getting everything he wants, and so is shifting to a more of a partisan approach to fiscal stimulus through what's called a reconciliation process that requires only 50 votes in the Senate rather than 60, because it looks like Republicans are saying no to some of the stimulus. Nonetheless, we still at PIMCO expect fiscal stimulus to be near $1.5 trillion in the new package. So it still be significant. So what we're trying to say is that the fiscal side of the story worldwide has been very good, but there may be limits. The second major force in this story globally is China. And we always have to think about China when we're thinking about global growth. It has been providing meaningful stimulus too on the credit side of the equation. But policymakers there seem to be reining in the horns, so to speak, on credit creation. It doesn't want bubbles to grow or occur. And so credit restraint in Europe would be another bounded factor. And finally, one could say no one really knows what the virus path will be, nor do we know whether there'll be scarring from all that's occurred, some negative fallout from the past year. And so there's a lot of negatives to be thinking about, a lot of reasons to be optimistic too. And for all we know, it's a revitalization of the outlook.
So I would say historically, when you look at Wall Street estimates and PIMCO's forecasts, it's my understanding PIMCO would be on the lower end of economic numbers. And it seems like, PIMCO is quite optimistic and on the higher end of estimates. And I was just wondering why a little more optimistic for 21 than prior years when you forecast?
It's a good point and good observation, Jamin. In fact, I'm often looked at as a resident optimist within PIMCO because I tend to be a little more bullish than my colleagues are. But I tend to share some of the longer term concerns that the firm has devised over the years, including, for example, a decade ago, the so-called new normal, the idea that economic growth would no longer be around 3%, that it might be around 2%. So tended to share that longer term view, but sometimes be more optimistic cyclically. Let me give a few reasons why we're a little more optimistic. One relates to it's a lot of math. There's a lot of pent up demand, et cetera. That's an obvious one. But think of this, the saving balances of US households. Many economists will know these statistics, but some put less credence on it than we do. So US household saving balances have increased to $3 trillion, massively, to $14.5 trillion in the past year. Now, the pessimists will say, well, some of that increase in savings was money that would have been spent during the pandemic that won't ever get spent or will get spent to some limited amount. In fact, in our conversations with the former Fed Chair Ben Bernanke, he noted, for example, last September, that the Fed had that argument too, that it was also divided on the issue, with some within the Fed saying that the wealthy were saving up money that they would have spent on services, and the money therefore won't get spent. But $3 trillion of buildup in saving balances is one reason to be optimistic. Secondly, there are wealth effects from the stock market and from the housing market. In fact, 3 to 5 cents on the dollar tends to be spent for each dollar of gain in the stock market, and an even higher figure, closer to the high single digits on the dollar, meaning 7, 8, 9 cents on the dollar, when home prices go up, and they are, with home inventories extraordinarily low. Another force is corporations. They built up $700 billion of cash last year. That might get unleashed if corporations become confident. Another point in the bullet list is banks. They built up also a similar number, 700 billion of excess lending capacity. And if the economy revs up, it'll be faring well. Finally, simply doing the math on fiscal stimulus and monetary stimulus, it looks like there's reason to be optimistic about the future, more than the consensus. In the short run, in the long run, we might be still more dour, thinking growth returns to 2% eventually past 2022, let's say in 2023, but that's a longer way off.
All right. Well, thanks for sharing that. And that's interesting math. So in your latest book, The Strategic Bond Investor, you have a chapter, Why Low Interest Rates Will Likely Persist in the 2030s. Can you please expand on that?
Sure. Thanks, Shaman, for that. In fact, I've published a 500-page book, and this isn't me looking to sell books, but it was my 6th book, and I wrote it during the pandemic, and lots of good insights I thought I picked up along the way from researchers and Fed and colleagues in talking about issues. But we've been talking about low interest rates for a while, and the idea that they could stay low. Sometimes we question this these days with the Fed fusing its balance sheet with the federal government by buying lots of bonds to help the government fund all the spending it's in the midst of. So we'll question it a little bit and watching it closely. It's important. We'll want to watch the inflation outlook. But one major factor in this, I mentioned the idea of a new normal. The old normal for growth before the 2008 crisis was 3%. It's a simple math equation, a 1 and a 2. 1% increase in the amount of people to make goods, to produce goods and services, and 2% increase in how productive they were. But that figure in the last decade has shifted to 0.5 and 1.5, meaning because of the aging of the population and people leaving the workforce in the older age bracket, the amount of people entering labor forces, the growth rate is only 0.5% and projected by the Congressional Budget Office to be 0.4% for the next 30 years. In Japan, the population today is 125 million, expected to go below 100 million by 2050. With fewer people able in an economy to spend on cars and services and homes, it likely won't grow as fast, and therefore a central bank would be more likely to keep its interest rate low. So demographics, a major influence in this equation. One footnote, though, the Biden administration and the private sector is more interested in creating greater inclusiveness in the workforce, and the Fed. August 27th of last year, it codified the idea that in its attainment pursuit of maximum employment, that it will characterize maximum employment only as one that is, quote, broad and inclusive, unquote, which means it'll probably let the economy run hotter and try to bring more people in, and it could push up the growth rate of the labor market and therefore boost growth and interest rates. In Japan, it tried something called womenomics. It's successful. 2 million more women working today than were 9 years ago. But the aging of the population has still the dominant force. So it's something to watch. And on the private sector front, there's something called stakeholder capitalism. It's overturning what was known as shareholder capitalism from Milton Friedman, the famous economist in the 1960s. He would have said companies should only care about profits. Today, this was seen in Davos, Switzerland last year at the World Economic Forum. It has a new Davos manifesto, which says that stakeholders, people, society should be put ahead of profits, and that'll actually increase profits in the long run. So that's one of the major forces. And the other one's really quick. Second would be credit growth. Banks don't lend as rapidly as they used to. After the credit crisis of 2008, banks have been more reluctant to lend. They've been very cautious about lending. That reduces the speed at which money is created and spent, and therefore limits inflation and keeps interest rates down. And finally, productivity, huge force. I said there's a 1 plus a 2 in the growth equation in the past, now a 0.5 and a 1.5. We haven't seen government investing in the economy much. It's been spending or providing money to spend. We haven't seen corporations investing. There's what's called a saving glut. And so money that could, if it were put into investments, would boost productivity. One example, in the 1960s and 50s, the US built the interstate highway system, 50,000 miles of roadway we still use. Enormous productivity gains from that. We'd like to see another big project and watch the news in the summer in Washington. We'll see if a $1 trillion infrastructure plan goes through. That might change the equation. So unless there's a big change on the labor front and the investment front, productivity, we should expect rates to stay low. The major caveat, again, is those two things and the Fed saying we want more inflation. We're not going to raise rates until there is. That might change the equation. So that's a chapter in the next edition. Who knows? I might have to revise.
Okay, interesting. So I guess for 2021, rates are going to probably be low, and the Fed's kind of come out with that. So what do investors do with cash in this type of interest rate environment?
Well, cash to us can mean different things. Of course, there's cash management, certainly in money market funds yielding 1, 2, 3 basis points, 0.01, 0.02, 0.03. It's probably not the best place to keep money, unless, of course, it's meant solely to be for capital preservation in a government-only type of vehicle, because T-bills, even looking out 1 year, are yielding less than 10 basis points. So we'd say in the cash world, cash management for money that is likely to stay in an investor's bank account, so to speak, for some time and not needed, probably stepping outside of the money market world a little bit. And I've written a book, by the way, on the money market of 1,200 pages. So it's an area I'm quite interested in, and so is PIMCO. But so we say step out of what's called the 2A7 world. 2A7 is the name of regulations that guide the money market to say a money market fund can't go beyond 60 days average maturity for the securities it invests in, and it can't go beyond a certain credit grade. We'd say step outside of that a little bit, a few months more, and also think beyond simply AAA toward highly rated other types of instruments. And this means looking at short-term types of vehicles. This isn't to sell anyone on it, but the PIMCO has vehicles like it, and many other managers do, where yields are a lot higher than the money market funds. That's the cash side. But thinking more broadly about investing with low interest rates, first, many will question, well, why should I purchase a US 10-year or anything averaging like it at 1.1%, 115 or so in recent days? There's no value in that. Well, for one, it's like insurance, of course. So we have to think, what I'm trying to say is think in a portfolio context. When we step in our car each day and drive, we know we need insurance. It allows us to take the risk of getting behind the wheel. The same goes for owning equities, credit, private credit. By having some fixed income where there's still potential for yields to drop in an adverse scenario where that 110 can become a 0.5, meaningful price gain, then it makes sense to have a high quality fixed income in a portfolio, simply in a portfolio context, thinking beyond returns and so on. But it is important if one wants something more than that, to be more active. And this means to use managers like yourself, because you can take advantage of movements and fluctuations in markets and mispricings, and simply not sign on to what's called passive beta. We like various things that require more attention from the bottom up, a lot of call it inspection, if you will, or research. This could include bank capital securities in Europe, complex securities I can't analyze myself, but returns could be low single digits, near 4% or so. We like banks in Europe because we think they're safe, even though profits won't be great for the equity investor. They'll be good enough for the bondholder to be paid back on various securities. Bank capital securities are equity-like in the sense that if things go wrong, they won't perform well. They'll trade like high-yield bonds. But banks showed remarkable resilience in the downturn that we think makes the asset class underappreciated. In corporate bonds, we're being careful about the cash instruments since there's been a huge rally. Yields are quite low, so we're being very careful and choosy about individual investments, but do think high quality, so-called spread alternatives still makes sense. Finally, I should add, we've liked the housing market a great deal. I mentioned that home inventories are near a record low, dating back about a half century. This should enable home prices to hold up. And so housing related investments such as agency mortgage-backed securities, which are a little richer than they were, and also non-agencies, the leftover subprime mortgages from the 2008 crisis that we think still good value in, a few $100 billion left of that market that was once $2 trillion in size, makes sense if you can extract the illiquidity and complexity premium. So it does require use of managers, people with expertise, such as yourself, Jamin, because it's not as easy to just sign up to passive beta, and one needs to be active to gain the alpha.
No, that's great perspective. Thanks, Tony. So kind of going back to the macro environment of the economy, it's my understanding PIMCO's 4 big macro factors for the next 3 to 5 years. You mentioned China, certainly technology, climate, and populism. And you mentioned Davos, stakeholder, and people. I was just wondering if you could talk about populism and how that relates to the economy and the business climate going forward.
It's a great question, Jamin. And some might take it to be a negative, but it's evolving now to become a positive in a sense. in the sense that if populism means that people will drive change by governments and by the private sector that benefits the economy, it can be a great thing. So as I said, populism these days means more equality. There's always concerns about income inequality. If it means a broadening of the labor force to include more women and minorities, that's a great thing. If you were the manager of a baseball team or whatever sports team and excluded certain types of people from being part of the team, that team wouldn't be as good as it could otherwise be. And so think of the economy as a team, and lots of people on the sidelines, tens of millions that could be brought in to use their unique skills to power economic growth. That could be a good thing. And so this attention to these private sector types of initiatives is a good thing. We heard from one of our advisors is Josh Bolten. He's the former White House chief of staff for George W. Bush, and he heads the Business Roundtable. It changed. It's a group of CEOs of giant corporations. So he's got good information from that group. The group last year changed, like in the Davos manifesto, changed what it calls the purpose of a corporation. Again, overturning a view toward a perspective toward our efforts toward shareholder capitalism, towards stakeholder capitalism. So populism is evolving in a way that can be good, but now and then, because there's volatility, because it creates a lot of uncertainty about the future. And you see this playing out these days in the whole GameStop saga, people seeing it as a form of populism in the sense that it's the little guy against the big guy. And that can be a healthy thing in the long run, although I'm not going to say that situation is a healthy thing itself. But this attention to the drivers of growth, people, human capital, skills, education, income levels, inclusiveness, so can be a very good thing. And it seems like the private sector is on board.
So before we go to GameStop, as you talk about just the private sector, and certainly the current administration has already talked about Buy America recently. Thoughts on what you're going to see changes there?
Well, the private sector seems to be moving toward the idea of Buy America itself. It learned during the height of the trade war that it couldn't rely on the supply chains to get parts and materials from abroad that it once did, because it could be disrupted by policymakers. And the tensions with China haven't gone away. They probably won't. We spoke with Condoleezza Rice, the former Secretary of State, last September, and she gave us this perspective that the problems aren't going away. They may take a different form under President Biden, but they're here to stay. And so this idea of tension abroad is one of the key things to be thinking about going forward, but I'm not so sure that it's something to worry about excessively. One quick perspective on the whole China thing is, should we as investors worry about that issue? Yes, to an extent, it can cause volatility now and then, but what good did it do an investor from 1946 to 1991 when the investor was worried about the Cold War? If they went into a bunker during that period, it did no good. Economic growth still did power ahead. That was a more of a nuclear arms race. Today it's more of an economic race, and the pie could grow, and it could turn out to be a very good thing in the long run. There'll be more growth and not less. And so let's not overly worry about that particular issue, for example. But on government, et cetera, I think in terms of the reshoring, as they call it, corporations are doing this again because they will still have to worry about what policymakers might do and might decide for themselves to change the supply chains. And the math is moving it there too, because labor costs in China are not as low as they were because it's prospered, and that's a great thing. And so the cost per unit of labor has gone up, and it makes more sense to make products here. One final footnote to that is that about 30% of world trade is for parts and materials, meaning lots of stuff moves around to make other things. And so each nation, each company is dependent upon others to make things. Components are needed, raw materials are needed. This interconnection is not likely to go away. It's just there'll be more insurance, self-insuring that occurs. But companies, in the end, final note is, will still do what makes them most profitable, and will look abroad. And this could maybe means moving away from China, not because of the politics necessarily, but because of the costs, and will move to other nations in Africa and other parts of Asia, such as Vietnam, for example, and others, to fill that hole.
So you mentioned this a little, and I'm sure a lot of our clients are going to be interested, and it's the hot topic, right? So, and it's easier to ask you this today because GameStop dropped 60% in one day earlier this week. But what has the investment committee at PIMCO talked about regarding GameStop, AMC, Reddit, Robinhood, shorting, and kind of the environment right now?
Well, we mainly think it reinforces chief beliefs regarding financial liquidity and the excesses it can create, and the side effects, good and bad. The good is rising prices. Look at the stock market back near its all-time high. Side effects are these pockets of volatility. Net, market financial conditions are fine. Borrowing costs are low for companies and governments, for people. There's been no meaningful disruption of financial conditions as a result of that volatility. It's these pockets of volatility, though. We do think, though, it does also show that how large swaths of fiat currency, this paper money, electronic money, can move prices when it gets mobilized. And there's lots of it. And so there'll be more of this for some time to come, most likely. And it's not likely to be withdrawn by central banks. If anything, the central banks are going to keep adding money. In fact, we expect the Fed, which is now buying 120 billion of securities per month, 80 billion of US treasuries and 40 billion of mortgages, to keep doing that till the end of this year, and then perhaps taper next year. And the first rate hike might not occur till, and Ben Bernanke agrees with this view, late 2023. Or maybe early 2024. The Bernanke view, by the way, is seems to be leaning more toward the camp of it might be a little bit sooner than the 2024 estimate that the Fed has itself, and the markets are priced for, but not a lot. As he said to us last week, certainly after mid 23, but not before. That's the most likely timeline at the earliest, and so it'll be a while for where this money moves prices. One final note. In a separate conversation we had last week, after a conversation with Ben Bernanke, we had a discussion about stranded assets. So it's a phrase used in the ESG world, the environmental, social, and governance world of investing. Stranded assets are assets that become stranded. They're not useful anymore. Think of an oil driller. Perhaps we shift to all solar and other forms of energy, and so that drill won't be useful at all, nor the pipeline. So there's a risk in that sort of thing. But the point is that I'm trying to make, it relates to GameStop in a sense that there are large swaths of money moving GameStop and other prices, and certainly large amounts of money from central banks moving financial asset prices, home prices, private assets, etc. But in the ESG realm, it's an area for investors to be thinking about. There's lots of money being redirected because investors are saying no to certain types of investment. Let's say, for example, brown investments, such as in the energy industry. And so where the money goes is something that investors always have to watch. And while the GameStop story is probably transient, the idea of the ability of large amounts of money to move markets is important, and more for the long-term oriented investor in the ESG realm, because money is moving away every day from these assets that are deemed to be risky for the climate. And so it's a very important connection there.
So, you mentioned liquidity. You go back to long-term capital management, hedge fund that imploded, and certainly some of these hedge funds got exposed this time around the last couple of weeks. And I've heard you use the term bend, but don't break in the past.
Right.
And what is a concern you have of something breaking and the implications to the capital markets?
Well, and it's instructive to go and look at Google Moody's historical default rates and find a picture or a table somewhere that shows the percent of certain securities that default under different rating grades. So AAA, you'll see only 2 AAA companies in the US, by the way, Microsoft.
But there are just 2 now?
And Johnson & Johnson.
It went
I think
from
it's just 2.
to 5, and now there's 2.
Right. I'm pretty sure it's just the
Okay.
Microsoft and J&J. It's amazing. But they rarely, and certainly the US is considered AAA, even though it's not technically. So they rarely will default. Triple B, the lowest of the investment grade before double B, therefore, will have a default rate of under 1%, at least historically. And when things get really bad, you might see it near 1%, but it stays low. So this is in horrendous conditions like 2008. I was about to look up my handy chart on it, but I'm afraid I'd wreck this our technical side of the story. But look it up, and I should have had that memory. But it tends to be low. So when we say bend but not break, an investor would consider purchasing a triple B rated asset or better, that where the odds of default are remote, at least from a historical perspective. But an investor looks even more closely with greater scrutiny at that triple B or let's say a double A or a single A, and says we think the odds are even lower than what is normally the case for something rated similarly. So this requires what's called the bottom-up research that, thank goodness, we have analysts within PIMCO, and other firms do this too, where analysts are very good at looking at company balance sheets. In my 6 books, there isn't a single balance sheet purposely because it's not an area I like. I'm not an accountant, never will be. I'm terrible at it. So I rely on credit analysts to look at, say, for example, in a company in the airline industry or an asset in the airline industry. It's a very risky area now, but there are certain assets, some called, for example, EETCs, Equipment Trust Certificates, where the investor receives a rate of return on the monies invested for the EETC issuer. It could be American Airlines or United Airlines or some other airline or something outside of it, where the income is based on stream of money related to cash flow on a certain type of plane. Now, these companies, airline industry, rely upon us getting on airplanes, and there's certain airplanes that tend to be in service more than others. For example, international planes aren't flying much these days, so those are riskier ones. But these days, a 737 will take flight more often than the international one would. But anyway, the point is that it requires a lot of bottom-up scrutinous work, and so alongside the credit rating from agencies like Moody's and S&P and Fitch, PIMCO will have its own internal credit rating that tells us whether we should be underweight, overweight, or so-called market weight, and we pick and choose based on that. So we want high quality spread alternatives, as it's called, bend but not break, term that Dan Iverson, our group CIO, has used many times, where the asset we think will have volatility, but you'll get your money back. And that's what a bond investor cares about in the end. All of that said, a critical part now is spreads are really tight, credit spreads, interest rates are really low. And even though we might like to own bend but not break assets, doesn't mean we should be building up lots of them, because then it leaves very little agility and flexibility and liquidity to move into an asset that's a bend but not break when prices are better. So while we're buying them, holding them. We're being cautious about building up too many, and in some cases shedding some that are, we think, overly rich. So we have the ability to go back in on bend but not break opportunities in the future. So leaving a little bit more cash than normal right now is to us a way of gaining alpha over the long term, and that's what we're doing.
So you talked about credit, and certainly we can get into the weeds, but a lot of our investors don't understand credit. Maybe you or PIMCO does, and the analysts. So if you look at high yield or junk bonds, how do you explain that market to someone that's not an investor or not in the investment industry, but that's going to consider investing in that type of asset class?
Good question, Jamin. And again, here's where the historical table on credit ratings would be handy, because there are a lot of double B assets, the rating grade just below investment grade, where there often tend to be opportunities where what's called the Sharpe ratio, which is the prospective rate of return relative to the prospective volatility, the bouncing around, tends to be high, even higher than triple B, because since it's double B, junk, where the default risk is higher, an investor is rewarded. But the double B default rate isn't exceedingly high historically, even in the worst case scenarios. And for investors that scrutinize the double B securities that they buy, then might have a collection of securities that has an even lower default rate than the rating class on the whole. So anyway, investors, because the default rates tend to be higher on those securities, are rewarded through higher yields. These days, it may only be around 4%, which is not high, but it is high relative to treasuries, which have an average yield of under 1%. And so there is compensation for the added default risk. But again, for managers that manage the default risk by scrutinizing the companies that they own, perhaps lots of opportunities, including, in fact, some fallen angels, as they're called. Sometimes companies that were investment grade, triple B, have problems like they did in the past year, and they get downgraded. They're fallen angels to junk, but they're not bad companies. They just came upon a bad set of income streams because of the pandemic, and there might be opportunities then where these fallen angels someday become rising stars, and they go back to investment grade. And so an investor who looks for those opportunities can also fare well. So I guess the bottom line point is to say that junk or high yield is what we'd rather say, because those that we hold, we don't consider junk. We hope it's where the default probability is higher than it would be for investment grade, and one wants to get an ample reward for that risk.
So you're a global firm. You've done an amazing job for your clients.
Thank you.
What differentiates a good investor from a great investor?
The number one thing, maybe this isn't number one, but it's the first thing that hit my head, is long-term orientation. I know myself personally, having joined the markets, so to speak, way back, I worked at the World Trade Center for Lehman Brothers in the 1980s, 104th floor. It's an amazing memories from that view. I know that in my youth, I would have less of a long-term orientation, and that hurt me as an investor, even though I didn't have much money to invest back then. But I remember buying, for example, options on Eastern Airlines calls, I think it was, that Eastern Airlines, which is defunct, would do better. But I know that that's a short-term investment idea, and probably not a good one. Warren Buffett would have us think more long-term, and I think that long-term mindset is crucial. Secondly, for the bond investor, thinking about default possibility is important, and recoveries, because, for example, high yield bonds, if a company is defaults, the recovery rate on the dollar tends to be historically about 30 cents. But for a loan security, which can have a similar double B rating, the recovery rate might be 70%, at least historically. It might be lower now because there are more companies having issues. But thinking about default risk and loss given default is important, the recovery rate. And finally, thinking globally is really important, and beyond what we know superficially, because the bond market is gigantic, bigger than the stock market globally. It's 110, actually it's probably more. I better get the new tally with all this government issuance occurring. Over $110 trillion. It's a supermarket. You need to go in every aisle, look on every shelf, because there's lots of different types of securities to invest in, lots of opportunities. For example, this morning, there was an opportunity to purchase, and I invest for PIMCO as well as being part of the investment committee, Brazil T-bills that are issued in euros, making it even more complex, but converted back to dollars through the hedging of the euros. So you buy it in euros, but you sell the euros at the same time to hedge it, and get a yield today for 2 months of investment of about 0.7%. It's a lot better than the T-bill, 0.01%. But that took a team of people to tell me the opportunity existed. So the use of active managers, people like yourself who have expertise, is vitally important to discovering opportunities. And this is, I'm speaking to the public markets, but the private markets also require great and intense scrutiny and expertise. And this requires, for most of us, to go to someone for help.
So when we look at due diligence, it's about people. And I appreciate the long-term perspective. I appreciate the patience. But if you have a young new person joining PIMCO, how would you describe in a couple of words the culture at PIMCO?
Well, it's evolved over the years, and I was fortunate to work with Bill Gross and Mohammed El Arian and for five years before they left, and then since then Dan Iverson as the man in charge, so to speak. But he's more team oriented than ever. But what has stayed is this mission toward excellence, and what I try to impress upon the young, particularly at PIMCO, just in case it is institutionalized, it's part of our culture, but the mission is to help people. We manage over $2 trillion, but that's a number. I know from visiting clients worldwide regularly before the pandemic, having been on television, et cetera, writing, et cetera, that we affect millions of people. If we invest money for a hospital, and I do, others do within PIMCO, we help that hospital with its investments. We help it to take care of patients better. We help a pension fund. We help someone to retire as they perhaps wish, or a family to pay for college, et cetera, et cetera. So much of what you and I do relates to people, and the recognition that it's extraordinarily important to people. And so sticking with that idea, protecting the money, being a guardian of capital, which is a term Bill Gross used to use, is important. Finally, what's new at PIMCO with Dan Iverson is this greater attention than ever to maintain a flat structure within PIMCO, meaning anyone with any rank with an idea can contribute to our investment process. And that's something that exists in many big companies, successful ones, where the talents of all the people involved can help that company to do its best, to perform optimally. So flat structure, not the vertical one where everyone from the top is barking orders, let's say, is something Dan Iverson has pushed. And more than ever, I've seen this idea of a flat structure and bringing in the talents worldwide to help us.
No, thank you for sharing that. So just to kind of pivot more towards you, Tony, and you look back at 2020, and I know you wrote your 6th book last year, but if you reflect back, what did you learn personally from 2020?
Just on markets, I recall again the importance of central banks, but constantly worried about the indebtedness of societies and whether we're using our resources well. So lots of money are put toward consumption, but we all know, as I mentioned with the highway example, we need money toward investment too. And I wrote a book about this called the Keynesian Endpoint. Is there a limit to how much money can be spent? Keynesian spending is economics, the idea of government spending money to boost economies when they're in trouble. And it does seem to make a lot of sense, but we need to be thinking about using the money wisely. I think that was part of what the election was about, with this idea of having an infrastructure plan coming up and more investments in people and human capital. And so that's one of the things that I'm thinking about. Is just the central bank involvement, the importance of it, but also the risks involved with the fiscal authorities not doing enough, perhaps, to engage. And I also think as well, one thing that comes to my mind as the optimist within PIMCO, perhaps it'll be a transformative period where we've rebooted the 2020s. It'll be more three things: digital. We're using, as we are right now, more computers, et cetera, to do things. More inclusive. We talked about that earlier. Really important to growth. And more green than ever. The economy could do well in this story. And there's more attention to the drivers of growth, people and investments. So I get very optimistic about the future when I think this could be a transformative story, and hope that policymakers don't get in the way.
That's great feedback. And I love your positivity.
Thank you.
So last March, when there was fear and panic in the markets, how did you help communicate and educate your friends and family regarding their investments?
Well, first, the most important thing I did, as I've tried to in the past, was to maintain tell these colleagues, friends, family, to maintain a long-term orientation, long-term perspective, to invest in America, to invest in the world, to be optimistic about the future, because people inherently are optimistic, and there always is advancement of the human race. And so don't let this be the reason you sell out of riskier assets when the Dow Jones is at 18,000, significantly well below where it was, where its starting point was around 30,000. So stay optimistic. So that was the top thing I did. I said, don't let your emotions get in the way. Invest the amount that you'll be comfortable if you lose a little, because it's going to be choppy, and choppy markets, you get chopped up, as they say, but stick with it. So the long-term orientation is probably the chief thing that I try to tell people, but I notice many who are not part of the markets as you and I are each day still find that prospect nerve-wracking. Yet, when markets rally like today, you see in the whole movement towards certain stocks rallying significantly. Why is it that the fear factor is so low? There's no fear of volatility then. So maybe you should think long term, and perhaps there's some things to sell. But again, just it's a matter of maintaining a long term orientation, I guess.
All right. So just to pivot a little, are you iPhone or Android?
iPhone.
All right. And your favorite app to follow the markets and the economy?
Well, I have the privilege of using the Bloomberg app, professional one.
Okay.
This is if someone walks by me at any time of the day, they might see me looking at market prices. But even without the professional part of it, there's still amazing market information there that I find difficult to find anywhere else. And so it's the top source for me in terms of news. But then, and finally, I should add on that point, I look at a lot of global newspapers for for different perspectives, because no one knows the local area better than locals. So I might have an Italian newspaper, one in England or Australia or Japan or China, just to have to see what how others are perceiving things. That's the
And
top
what is
thing.
your favorite app for personal use?
People will laugh. I'm older, 56. I saw men land on the moon in the 70s on the boob tube, large TVs that we don't have today, black and white. And so I have a NASA app. Now, I would say, and I tell people this all the time, in 2024, a woman will land on the moon, will step on the moon. It's already in motion. It's on the calendar. It's going to be super exciting, crystal clear HD pictures of the moon. It's going to be great. And so I look forward to that. And so next week, for example, we are landing another planetary mission on Mars called Perseverance. I have digitally put my name on it, I think with another million people. So my name will be digitally on the planet Mars. I'm excited. I know that I'm signed on to the webcast to watch it land. It's amazing. We can watch something land and see photos of another planet. So I get excited about that, as you could see.
Sounds great. I appreciate that. I learned something new. NASA app. I'll check it out. All right. So last couple questions. Do you read the physical newspaper or digital?
All digital.
All digital.
PIMCO I used to have the Wall Street Journal and the Financial Times delivered to my desk. A number of years ago, we switched, and I'm happy to go all digital.
All right. Food section or entertainment section?
Both. I during the holidays made some interesting bread and triple layer Italian cookies. Some things from the New York Times pages. The food section is amazing. So
Wednesday food section is amazing. I love it. Live sports or binge watch a TV show?
I played baseball in high school. I find that I rarely watch sports anymore. I just don't feel I have the patience. So I'd say more likely to watch other things. I don't watch a lot of TV generally. I don't have cable anymore. Cut the cord. Watch a lot of movies mostly, here and there when possible. As you know, in our profession, we're connected to markets 24/7. So I need something in the background. So usually it's an action movie. It could be the Terminator or Aliens, because you don't have to pay attention. It's just a bunch of noise. I don't need to pay attention to the story. Those are the things that I tend to watch.
No, that's good to know. Sneakers or dress shoes?
I have lots of Van sneakers, but I love to wear my shoes that I bought in Italy for under $100. Italian shoes that I always bring back when I go there. I can't wait because I need a new pair. Having not been to Italy because of the pandemic, so find amazing shoes there. I love wearing them, and I'm Italian 100% by origin, and so I have a connection to my Italian shoes, but only if they're a bargain. I won't pay the prices you see here.
Love your value investor mentality.
Yeah.
Morning workout, evening workout, or no workout?
Morning, and morning writing too. That's where my energy is. Later on, more for just reviewing things. But the burst of energy, I can't write much well in the evening as well. I feel I'd love to get going early. I'm an early riser. Doesn't mean I go to bed early, but my energy is great in the morning.
Thank you very much, Tony. Thank you,
Jamin. Thanks for those great questions.
Clients. And please keep a positive attitude like you have and be amazing.
It's quite nice of you, Jamin. Quite a great honor to be with you, and great and amazing questions. And you're certainly serving your clients extraordinarily well.
Thank you. I hope you've enjoyed today's interview and gained some perspective and insights on Tony and PIMCO's investment strategies. Be sure to tune in to future videos. Thank you.